So welcome everyone to today's webcast. I see that people are still logging in, but in the interest of time, we're going to go ahead and get started. Really appreciate you all joining us today. I'm Pat Soldano, the president of Family Enterprise USA. If you don't know who we are, we advocate for family businesses in Washington, D.C. at a national level. We advocate for all sizes of business and all industries. And specifically, we advocate for tax and economic issues that affect the families of those family businesses. So today's webcast is Navigating Uncharted Waters in the Insurance Industry. This presentation explores the evolving challenges facing both businesses and individuals in today's turbulent insurance landscape. Attendees will gain insight into the economic forces that have led us to these choppy waters, rising costs, shrinking coverage capacity, and the growing prevalence of uninsurable risks. We'll trace the path that brought the industry to this point, examine the underlying economic pressures, and outline practical steps clients can take to regain control. Rather than dwelling on the anxiety-inducing obstacles, our presenters will focus on actionable strategies within reach, emphasizing what can be controlled. Through a risk management lens centered on prevention and mitigation, participants will learn how to build resilient insurance plans by adopting proactive measures and embracing risks models. Purchasers can better manage the financial burden of today's market and chart a more stable course forward. So our presenters today are both from USI. We have Jim Kane, who is the Senior Vice President of USI's Personal Risk Insurance and he is in New York, and Amber Toney, who serves as National Select Commercial Sales Director, and she is in North Carolina. Thank you both for joining us today.
Thanks, Pat. It's great to be with you. Thank you for the invitation. Both Cincinnati Insurance and USI have enjoyed our relationship and the important work that you do. So we're glad to be here today to take this on. As you described the description, I was wondering whether Amber and I were ready for all that, but we're going to try to do it. So let's start with, in terms of what we're going to talk about today. You've had the introductions. We'll talk about the state of the market, what the future holds. There's a lot of optimism right now in the market, but not quite fully there on the premium side. And then how steps you can take to mitigate and impact those rising costs. And we'll take the questions as we go. We'll also do a couple of polls during this and get the feel of the group and what they're concerned about. And why don't we start with the first one? So it's a mix as to what people feel out there or sharing with us what they think is driving it. And so let me get the next slide, and I'm going to turn that over to Amber.
Yeah, thank you, Jim. So how we got to the current market is really defined by these billion-dollar events, which are happening more and more. You will see on this slide that the billion-dollar events from these are just what happened in 2024, right? There are 27 total events that we consider billion-dollar events. That's a big number. The average number of billion-dollar events from over the last 5 years in the United States sits at 23. So 23 is the average. So in 2024, we were obviously above average with 27 events. What's even more profound, I believe, is from 1980 to 2020, just 5 years ago, the average billion-dollar events a year sat at 9. So we went from 9 as the annual average to 23. That's a big jump. When these events are broken down, it surprises me that fires or floods would not be topped ranked. That is what you tend to hear. I think most from the media, right, is about the fires and the floods that are happening. In 2024, with these 27 events, one of those was a fire event, and one of those was considered a flood event. All others were weather events such as, tornadoes, hurricanes, snow, ice, wind, hail, and drought events. Um, Now, these events, this is 2024 results, right? And do not include the devastating Palisades or Eaton, California fire data, which occurred in 2025. And we know the impact of those are quite significant. Um, Jim, can we move to the next slide? Thank you. You will see additional numbers here, which show how we as a nation face these disasters and how they happened. These are 1 in every 100-year events that we are now seeing happen annually, right? That's wild. The graph shows data of just under a 20-year mark with 190 events driving billion-dollar cost, right? So within 20 years, 190 events happened, which are over $1 billion. So why do I share this? This increase of natural disasters is a major pain point with where the cost of insurance comes in play and is making the job for insurance carriers who perform risk modeling quite difficult. It makes underwriting risk all the more complex and stricter on what insurance carriers can or cannot offer. Capacity in prone regions of these events becomes very limited, and both the carriers and the insureds, so the business owners or you personally, you need to settle into a new norm where severe events are anticipated annually, unfortunately. There are a lot of reasons I highly recommend any business or individual to work with a trusted broker to navigate all things insurance. But understanding this landscape and the best protections you can have in place and available to you, I think is of the utmost importance. So have a conversation with an insurance professional for sure. If you are caught in one of these billion-dollar events, even million-dollar events, you want to make sure you are covered properly and with a partner that can help you manage the claims side of things. So thank you, Jim, for moving to this page. We just talked about the catastrophic losses, right? About all the weather, natural events that we really have no control over. That's one reason we are in the current kind of state of the market that we are in. You also have state regulatory restrictions, which are changing constantly. Carriers are having to navigate a very complex regulatory environment at the state level. Many regulations can limit the flexibility a carrier has with pricing and how they structure policies. So this can also impact decisions from insurance carriers and can hold them back from continuous innovation. As brokers, we are having to stay on top of recent state regulations being put in place to help our clients. The reinsurance market is third. The reinsurance market capacity continues to tighten. Reinsurance is insurance where one insurance company purchases from another insurance company to help protect their liability in the case of a major claim or event. There is a reduction in available capital and stricter terms are in place. It's just another hurdle in our world. The geopolitical tensions. This can range from war to economic sanctions, which can impact the financial markets and investor confidence. And this leads to uncertainty for carriers, the carriers' investment portfolios, and forecasting how a company may perform. We are also hearing from carriers about the concern of tariffs, right? The concern sits around their ability to restore businesses or individuals in wholeness. right? So claim costs may ultimately increase if the price of products used to make some whole after a loss are being tariffed. They're going to cost more. So let's say we rebuild a home or need to obtain machinery that maybe a manufacturer may need to do their day-to-day work. The items needed, the wood, the tools, the machinery, they may come from outside the states. And now there are new higher or additional tariffs in place. The price is going up on that product, and that's just something else, right, that we're having to navigate right now. You have rising jury awards, which are often referred to as nuclear verdicts. They're really high, large jury awards, frequently exceeding $10 million here in the States. This too affects reserve adequacy and forces carriers to reprice products or maybe even exit providing options for some risk that they historically have provided options for. Cyber threats is last. We will talk cyber coverage further into the presentation. However, it is good to note that cyber risks are real and causing some commotion in the market as well. You know, AI is no longer an idea. It's or a concept of someone playing with it. It's heavily integrated now within our insurance world. And there are different types of AI at this point. Two that come to mind, and I've been kind of getting my hands dirty in here recently, is your standard AI, right? Which I think kind of chat GPT, like basic level, um, uh, pulls information and then summarizes the information for then a human to review and make decisions based off of whatever details it provided you. You also then have GenTech AI, or sometimes it's known as generative AI. This is a modeling which does not provide recommendations. It makes the decisions for you. For example, an insurance carrier may use generative AI to underwrite a risk and determine what type of quote they may provide you. You know, will they provide a quote at all, or what terms and or limits that they will provide? This kind of takes the human element out of it. Knowing this, I would urge you all to understand that this could be a difference maker in what coverage or premiums you're being handed. If you have a broker who represents your business, you will be represented in the marketplace. You will have negotiations done for you on your behalf versus whatever AI may spit out. So always, that's a very, very important reason to have a broker partner to help with those negotiations and navigating that space. I know, quick story, and then I'll move on. Jim and I were discussing the other day how this is being used with some carrier partners that we work with. I won't get into the carrier example, but I will share my internet cable provider. They use AI. And if I wanted to cancel my subscription, I would log online and do this through the chat capability, right? I would type in, like, I want to cancel my subscription. Through generative AI, my provider will determine, fine, let's let her go. They will provide me a link through the chat that says here, click here to continue with the cancellation. But if AI quickly tells the company, hey, wait a minute, she's been a customer for a while, not a pain. She pays on time. We want to stay in this market. They want to keep me as a customer. The AI will say, hey, here's a phone number. You need to continue with your cancellation. Call this number. And then guess what? You get a live person, which then there's going to be a conversation and they're going to try to help save me as a customer. So I share that because I just think it's quite an interesting tool, and the way that it's being used and impacting the insurance world is mind-boggling, and also just kind of our day-to-day. And I don't even know sometimes if we really even realize it that it's happening. Jim, anything to add in regards to any of that?
But just from my perspective, because I'm handling individual insurance programs, many of the same concerns, many of the same types of losses, and really trying to manage the explosion in premiums. So it models very similarly to the businesses. They're a little ahead of the softening than we are, which we'll talk about. But that would be what I would add.
Wonderful. All right. I think you've got the next one.
Thank you. So this is a very busy slide, and I apologize for that. We're not going to go through the whole thing. A couple of key points on it. This is tracking the GDP, is the blue line. The red line is commercial lines or business insurance, and then the yellow line is the premiums in personal lines. And as you can see through most of this chart, the blue line and the the red line, the commercial lines premiums, are very close to each other. It follows the growth of commercial premiums typically ties pretty closely to GDP. And you can see starting in 2020 that they separated by quite a bit. And what you just heard on those first few slides are all the items that are driving that. So from 2017 all the way through to 2020 up through COVID, we were not getting adequate rate on a consistent basis, and yet we were seeing climbing losses and loss cost factors. And so you began to see the premium separate from GDP because there were different items pressing on it. In addition to that, as Amber has indicated, we've gotten more sophisticated in our modeling, and AI certainly has a piece of that as well. And so when they began to lose money, the insurance companies are going to come back and take a look and say, geez, where are we overcommitted? And is the original plan the right one? And we're finding out that not only overcommitted in some areas, but they're high catastrophe areas today. There was a point where you could point out states like Arizona and say, geez, if you're going to buy a property, that would be a good place. But Arizona is no longer not a catastrophic exposed states, and most of the other 49 states fall into that category. And I would just point out on the yellow line, the personal lines, it doesn't follow quite as tightly on the GDP, although they're all kind of bunched together there for the most part. And what I want to point out here is not only did those rates begin to rise at the same time that the commercial lines did, but they're still showing that they're going up. And the reason for that is, in fact, I have clients that do their home and auto and their cars and boats with me, and we also handle the business insurance. And we were doing one renewal, and the client said, geez, I just finished my business insurance and we got a 15% reduction from last year. This was a couple months ago. And he said, I guess we're going to get the same thing when you renew my home. And I said, well, you can stop right there because that's not going to happen, because it's different on the personal line side in that the rate is controlled much more by the regulators with individual insurance. And we'll talk about this as a solution later. We're seeing more and more business moving into non-admitted or excess and surplus lines, so that the insurance companies can address the rates faster by adjusting coverages and using larger deductibles and things of that nature. And that is why the commercial lines is ahead of us in terms of reducing this red line going down, while the yellow line continues to rise. We'll be about I'd say 8 to 12 months behind that market. It will eventually change, and we are seeing a softening that we're not going to see 15 and 20% increases. We may see 7 to 9% as it ratchets down, and they get more control over the losses. On this is also a busy slide. We're not going to go through all these. You can be happy to know. What I'd like you to focus in is on the column with the dots in it. All the red dots indicate in that line of coverage, the top half of this, top 2/3 of this is business insurance. That means the loss ratio has gone up, meaning that they've paid more in claims. The green ones would say that they're doing better from an underwriting standpoint. And then on the bottom is the personal lines with the auto and liability, and then the homeowners. The blue bars are commercial lines, are as a division have seen a rise in their loss ratio by about 3%. So you can see that that's moving more quickly. On the personal lines, it's still red and it went up by 11%. And so the real simple answer to this is that if the losses don't get better, then we're not gonna see the rates get more controlled or more competition in the space. As that gets better, you'll see more companies open up, looking to write business and to reduce the cost of the insurance as a whole. This chart has to do with reinsurance, and Amber touched on that briefly and indicated we talk about it. And so this is a chart on the capacity in reinsurance. I like to refer to reinsurance as the insurance companies hedge on their bet for the risk that they've taken on for you. So they'll write a $40 million home and say, we'll cover the first 30 million, and the next 10 million on wildfire is going to be passed off to the reinsurer, for which they pay a premium. What I want to point out is in 2022, we went from $670 billion of capacity all the way down to $575 billion in capacity. The problem with that was that for 4 years, they did not make any money. And so the decision was, we're going to stop investing in this, and we're going to shrink the amount of capacity we're going to grant. And so on the renewals in that year, what the insurance companies got was not only a restriction on what they could write, they were going to get about a 20 to 25% increase in those premiums. And you don't need an advanced degree to figure out that all that cost was then passed on to the consumer. On top of that, if they were writing wildfire, if they were allowing them to pass off some of the wildfire, and let's make a number up that company-wide, they were doing 10 billion in wildfire in 21, they came back and said, we'll give you 5 billion and we're going to charge you 25% more. So it was a double whammy. It forced them to have to cancel policies so that they could unload some of the wildfire they were doing, and then consequently pass on the 25% for the hedge on the additional 5 billion. That is the shortest way I can do that, but this is a trigger for the insurance companies. It's one way that they, again, hedge their bet and try to make profits. And that was a double whammy in terms of less coverage for double-digit increases in premiums. That continued into 2023. But as you can see, they began to reinvest because they got some rate, and it turned out that they were able to make some money. And by the end of 24, it actually reached a 700 billion in capacity, very close to where we were in 21. And that was in large part 24. Actually, despite all those losses, was rather good. However, the real impact on the Palisades did not come till January because it was so late in the year. The reserves did not get put up. So that's going to be a 2025 loss on that. But it is reconstituted. There's capital there, and they're back in it. They're not quite clear, right? They're not getting 25% rates, rate changes. They're now getting, say, 9 or 10, and it'll come back into a better focus as they continue to get adequate rate. On this side, there's another method that really helps sometimes and doesn't help so much other times. This is an example in Florida. On the left is the reaction to the legislation that was passed on a number of things, but primarily the assignment of benefits mess that happening in Florida, where after the loss, the lawyers had clients sign over to them the rights to collect, and they continue to collect on a claim that was closed for the client. They closed that gap, and they indicated it would take a couple of years. And you can see that from this chart on the left that is beginning to take hold. On the one on the right, with all the aqua lines there, you can see the drop off here. This is the number of policies or the coverages that are being provided by the state of Florida's market of last resort citizens, which in the course of this became one of the top 10 insurance companies in the country in providing coverage only in Florida. But it dropped from those high peaks there on the far right to nearly nothing. They have depopulated it by making very large properties ineligible and forcing others to be moved out. That's good news for the state of Florida. It's a challenge for them. Had they had to pay all those claims, they would have been in real jeopardy of not being able to meet the demands. However, the rough part about this, and the one that's kind of hidden, is most of the companies that they're moving this business to are seriously undercapitalized. The measurement in the industry is typically 2 to 1 written to surplus. So for every $2 that you write, you have $1 in surplus, which is reserved to pay claims. In this case, they're allowing these companies to stand up with, for every $10, you can have $1 of surplus. Our concern would be if we get hit, or I should say, when we get hit with a Category 5 hurricane on the Florida Peninsula, The bigger catastrophe may be the number of bankruptcies from these insurance companies with this in a state that probably does not have the money to do it. And if they turn to the federal government, that's really not a really solid financial house right now. So that is their solution. It's moving the needle. We are seeing appetites getting broader and rates coming down and a little more competitiveness in the state of Florida for property, but it's been slow moving. And so that's kind of a quick look at the effect that that reform from a legislation standpoint and a regulatory standpoint can help the market. Let me get to the next slide.
There we go. All right. Thank you all. Okay, so we have shared several insights into insurance, kind of the insurance world, and maybe what stands behind some of the headaches that you have been feeling. There is a lot with insurance that is uncontrollable, but there is also a lot that we feel that you can control traditionally or maybe with alternative methods. So we're gonna run through some of these for you. The first is the regulatory insurance. So in my world, in the commercial, the business space, this would be considered your auto, your workers' compensation liability. If you're a medical professional, and you have your medical license, maybe medical malpractice coverage, right? So these coverages are required in the United States, unless for workers' compensation, unless you sit in Ohio, Washington, Wyoming, or North Dakota, workers' compensation is not required. There's a real workaround. I'm sorry, there's not a real workaround in having these coverages in place. It's mandated, right? But things you can do. So what are the controllables? Is you can make sure the limits you have are correct, right? What coverage do you need in the event of a loss? You can make sure the structure of your coverage, how your exposure is classified or being rated is out there. It's right. Are there credits you should be receiving? Are there exclusions on the policy that maybe shouldn't be there? And getting them removed. Or can there be additional coverage endorsed? Do you have the right return to work program in place? And so on. So yes, it's a must in having this coverage in place. However, I just named off a few, just top of mind ways to work around what different ways that you and your broker partner can look at making sure that you have the right coverage in place and on the table to select from, so you are properly holistically covered. Compliance. If you are working with other companies in the business world, clearly defining who is responsible for what is a necessity. This can protect you tremendously. So I highly recommend having your legal team or an attorney that represents you assist with language being used when there's any contract in play, right? At a USI, we can tell you the insurance verbiage to use, the insurance requirement standards, but your legal team will know the legal verbiage to use in those contracts, or with contractual negotiations and or agreements. But having that contract in place, having that formal agreement, if we're working together, who's responsible for what, can be a game changer in protecting you. Liquidity, I can't get that one out today. Liquidity. This is all about financial protection being in place in the case of an unexpected loss or event impacting your personal or business world. Special services. So many businesses are specialized and need tailored coverage as a part of their package program, right? This is where here at USI, we feel we specialize in this on the commercial side of things. Every member of our team is a specialist within an industry specific vertical. We call them subject matter experts who assist clients or prospects daily in knowing what exposures are, what state laws are, and how to best protect you, providing options and solutions. And then there's self-insurance. Self-insurance, let's talk captives, right? The captives seem to be top of mind for many across the states right now, and there's lots of buzz in the insurance world surrounding captives. And is a captive model the route you want to go, or do you want to stay traditional coverage placement? So first, what is a group captive? I would say essentially you become the insurance carrier, right? A captive is a group of companies with similar exposures or risk profiles that say, hey, let's protect each other. Let's help each other in the event of a loss, and let's kind of self-insure without a carrier partner. Why join or form a group captive? Potentially lower cost. In the end, you avoid a third party insurer. This allows you to customize coverage to what your risk needs to be. And I think the biggest takeaway is it forces you to have a risk management strategy in place, right? It is a necessity to understand your risk, what safety protocols need to be in place to make sure all I's are dotted, T's are crossed. And you're in it with kind of a peer group, right? And so they're going to hold you accountable to that. What I will share with you when it comes to if I would recommend a captive for you, my answer, like every time, unless we're going to get in the specific weeds of your specific situation, risk exposure, financial setup, is it depends, right? Cannot generally say it's a good concept or not because it's situational. Captives offer a broader risk transfer strategy. And so it's up to you in the end is are you willing to and do you want to take that on? I will share in what I'm seeing big picture within the industry is in the liability space. I am seeing in the transportation in industry that captives may be getting used a little bit more these days to build kind of excess towers for additional limits needed. Jim will talk about some nuclear verdicts later in the presentation, but one thing we are seeing specifically on the medical professional liability side of things is that due to these nuclear verdicts, there are pain points with this coverage. Healthcare organizations, long-term care facilities, assisted living facilities, and so on, they're starting to look for solutions which leads them sometimes to a captive model. When it comes to the property side of things, it is not that the prices are going up on the commercial side of the house, but that the capacity that the insurance carriers have to offer and to extend. Right now, that tends to be more of the meaty part of the problem. So for you to insure your property at the right value, in the case of a loss, that may be tough, especially if you sit in a region impacted by recent weather, uncontrollable events. Jim, anything to add to that?
Yeah, I would add two examples from the successful family or individual perspective. Cyber risk, I think, is often confusing on our side of the aisle as people, our clients hear, well, I'm not taking anybody's personal information. I'm not taking credit cards. Why do I need cyber? Because we shifted, right? That is the same thing as identity theft and electronic funds being stolen. So cyber risk is a real one for individuals. And I would say that would fall in category 4 in a large way for families and individuals. If you're purchasing that, it should include monitoring systems. And it also should include a transfer of funds that get stolen because the hacker intermediate was intervene between the transmission to the bank or the financial institution. Many of the policies that are connected on homeowners do not cover that because they didn't get into your bank, and they consider it you gave it away accidentally. And so there are policies out there that cover that, even if you were duped. And so there's real difference there, and it's a rising concern. It's in the top three of virtually every family survey about risks they're concerned about is cyber risk. And on the self-insurance, I would also include your willingness to take on risk just because you can afford to, because that is a good way to increase your capacity and manage your premiums if you have the wherewithal to do it. As an example of your very good point that it's more about capacity right now than it may be premium, because they're being very stingy with covering things. And in our world, one of the largest providers of high net worth homes is rewriting every policy at $20 million or more on the property, on the home, to non-admit it. And so that is because they're going to cap the replacement cost at 150% when it used to be unlimited. And the only reason they're doing that is it's going to release some capacity. So I think we're seeing, particularly in the ultra high net worth, we're seeing the same reaction that you just described from the commercial side.
Yeah, that's great. Okay, thank you for that input. Okay, can we move to the next slide?
Yes.
Thank you. So just talked about kind of what's happening that we can't really control in our day-to-day, right? I'm not controlling the weather. I'm not really having a say in the reinsurance market and regulations that are being put in place out of our control. This photo, this picture diagram, what we find is most brokers who may represent you work on a few of these circle items. And then the rest, it is up to you, which ultimately means for majority, it's not getting done, if we're being honest, right? Or not getting done consistently. At USI, we believe you start with loss control efforts all the way through, which leads to an investment in protection for safety and cost savings. So we focus on hitting on all of these consistently. Today's market, risk management is not an option, whether you're doing it the traditional route or whether you're doing it through the captive model. It is evaluating, planning, securing, and maintaining, and then repeat on an annual, couple times a year basis, constantly evaluating, planning, securing, and maintaining. So keep that in mind, this little diagram, because if I'm working with someone, I want to make sure each of these are being hit on annually. And a lot of the work is on you as a business owner or a personal individual to do the assessment. But man, if you're working with a partner, make sure they're assisting because they can assist in big ways. Jim, can we move to the next slide? Thank you. All right. The last bit I will touch on when it comes to protection is cyber, how to avoid cyber threats. Jim just touched on cyber in the personal world and dropped a few good nuggets on that being a main focus and things that you should be able to do to protect yourself. When we talk about mitigating your risk, one of the major exposures we are continuing to see with no minimal or very minimal, with no or minimal coverage in place is the cyber world. Cyber exposure can be avoided, however, or at least avoided as best as you can. I guess nothing can be totally avoided. But what I would say about cyber is there's got to be knowledge in place on how to avoid putting yourself out there for this loss, for this event. Strong passwords, right? That one seems easy. Training your staff on best practices, right? Making sure your staff is coached to not click on links coming from unreliable or unknown sources. Maintaining a secure software program. Updating that software program, right? If you bought a software program 10 years ago, you may want to update it. It's probably outdated. Building a response plan in the event of a cyber attack, having your data backed up in multiple ways. Keeping your eye on your credit, right? Whether it's business credit or personal credit, man, making sure no one got a hold of your financial information, your personal information. Signing up for monitoring services and so on, all can help. Um, Spoke on captives earlier, a couple slides ago, and we are seeing growth in the cyberspace with captives, as well with a focus on implementing large deductibles and excess layers. Okay, so that if you're thinking about a captive, cyber coverage can be in a captive model as well. However, with that being said, cyber pricing in the business, the commercial side of the house, it's stable right now. And in my opinion, still relatively on the cheaper end for the coverage and protection that you do receive. In the case of a loss, if coverage is written traditionally, you have good limits in place that cover several facets of the cyber world hitting you. And you also have a carrier partner, a broker partner to help you navigate the claim scenario, which is extremely beneficial because it is a very technical world, technical exposure. I think it's pretty clear cyber threats are not going away, which means incidents surrounding business emails being compromised and ransomware events, along with the AI related threats, will continue to develop and really test cyber protections. So, no, this is important. It's not going away and should really be a priority uh, for you. Jim, anything to add, or would you like to move on?
Yeah, I'm going to move on. Thanks. That was great insight. This slide is all about loss control and risk management. These photos I'll go quickly, but life safety first. So there are measures you can take to keep your business partners, your employees, and your family safe. I always say if you decide to have your fire escape plan when your living room is already on fire, that's a problem. So you need to do that in advance and have a plan and communication. Where do people? Where can you reach each other? If you're in a business when people exit the building, things of that nature. On the property safety, there's lots of options. On the right here, this top picture is the water monitoring system. That's a nice to have right now. It's going to become required, I believe, on homeowners. And I think in large businesses, particularly habitational, they're going to have to come up with some way to monitor the flow of water. The next one is the spark arresters that you put into the roof of a home in California. I had a colleague say, "Hey, should I do that, and we'll make my house in California more appetizing to the underwriters?" I said, "I don't know that, but it might save the house. So why don't you put it in? It's your home, right?" And then down here is a loss control treatment for flooding. And as you can see, the gates go up when the water occurs, and it's holding it away from that building. There's been massive, I think, steps forward with flooding, with loss control measures that you can take. Something as simple as an inflatable item that goes under your car, and if it floods, it will basically rise with the water and won't destroy the car, won't get ruined. So there's affordable things and simple things you can do to prevent this property loss, and it's a really important piece of it should be a really important piece of your strategy in this current market situation. Now, quick story on the water monitoring. I got one at an insurance company meeting. I installed it in June, and my wife and I were headed to Boston to visit my daughter and our brand new granddaughter, and we were going to be there for 2 or 3 weeks. On the way to the airport, the alert went off. And I looked at it in the back seat of the Uber, and my wife said, "You must have left the water running," which I think everybody jumped to that conclusion. It was my fault. So I turned it off, and then I turned it back on, and it happened again. So I got my 26-year-old son out of bed on Sunday morning before 11, which is the real miracle. And he went over to the house, and I turned the water back on, and here one of the toilets had malfunctioned, and he could hear the water hitting the lid of the porcelain lid, which had already been lifted halfway off the toilet, and the water was about an inch from overflow, which we dodged probably somewhere in the $100,000 to $150,000 loss because we would have been gone for 3 weeks. That cost me about $2,000 to install, and I got a $1,500 credit on my homeowners. Now that won't be equal across the board for everybody, but that seems to me that paid for itself already. So if you haven't done this and you have a secondary home that you're not in all the time, that's an investment well worth looking into, and you will get a credit for it for the vast majority of insurance companies out there. Our last slide before the final poll is just some examples of it in terms of these nuclear verdicts that you heard about. And these are, for examples, that it is for real. You can get $100 million claim. And these are just some examples of it. I read another one just the other day where it was $100 million compensatory claim that the courts awarded. They knocked it down to 90. I'm not sure that made a big difference, but they knocked it from 100 million down, and it was a sexual assault charge for someone at work that had just a terrible background. There also was a $300 billion lawsuit for a DUI where he ran into a grandmother and the granddaughter and killed both of them, and that was the award that the courts gave. Now, they're outliers. I get it. You're not going to see those every day. But the reality of it is you can get something considerably large that would put you in a very, very difficult position. And we should be all starting our risk management program around a large liability claim, which could put our business out of business or have us lose our home or all our assets because we didn't have enough coverage. The cost of the coverage will be considerably less than it would cost you out of your pocket with just the damages and then your lawyer fees. And so from that standpoint, get what you're comfortable with and make sure that you're protecting yourself as best you can to avoid something like that. So we have one more polling question, and then we'll move to if there's questions left. I think we ran a little late, so I'm sorry about that, Pat. That's good. I think we got that. So that's a great result and exactly what we would hope for. We're going to provide Lauren and Pat some checklists that we have, and we will. Our information is going to be on this last slide. So if there's something that specifically you'd want, and we have one, we'll be happy to send that to you. But with that, Pat, if we have questions, we'd be happy to field them.
Yes. So Jim and Amber, thank you for that. I have a question, and you've addressed it somewhat, but we have some time left over, so indulge me on this. In the registration for people that signed on for this webcast, there was, as we've discussed, a lot of conversation around captives and self-insured, and Amber talked about group captives. But let's talk about these individuals, because I'm hearing also more and more from families, family offices, family businesses creating their own captive and doing that themselves, as well as some of them are doing that even in combination with self-insured. So maybe you could give us some discussion around that, what you see.
Yeah, and Amber, if you're right, I'll take that one. I agree, Pat. I hear the same thing, and it definitely, those conversations start when we see what we call a hard market, which we are. We're not we're stingy with capacity, and we're driving up premiums. And it's at a point that I would say it's something that the client should be considering. And I'm going to qualify that in a minute. We had a case in California. The house was about $1 million to build, and his renewal was at like $330,000. And he said to me, "If I get 3 years with no losses, I can build it myself." And that's a legitimate perspective. I mean, it's not. I mean, there's expenses beyond that, right? But at the same time, he would keep $300,000 in his pocket and obviously get some return on that. And so I think that's where we are now. What has happened usually when we get to this point is when the discussion starts, everybody is interested because they want to get control of the process, believing that the insurance companies are not being efficient and they're holding on to profits, and they set the losses because they set the reserve. So, are they really losing money, or are they just pushing up the losses? And the reality of it is the amount of capital that has to be sunk into something like that is enormous. And so the first thing we would say is if you're going to do it, you have to want more than just controlling the premiums. Now, because there's going to be a bad year and you're going to have to put more capital in. It's inevitable. You saw the march of $1 billion events, right? So at some point you'll have to recapitalize, your own captive. Secondly, you can't stand it up and then not pay any claims. You have the right to withdraw a claim, but you have to actually function as an insurance company. So you're going to have to run that. You're going to have to hold board meetings wherever you stand it up. And then the last thing would be is to write the coverage the way you want it. And so if you're not getting wind in Florida and you stand up a captive for your properties, that you definitely would put wind in there because you make the decision as to what that would look like, and you might as well have the coverage if you're going to work the insurance side of it. And in the years that are successful, that goes into the surplus, and it's you're going to be invested in that and have to do those things. So it can't simply be an effort to try to save premiums, or you're going to wind up sad. And once you're in it, exiting it is even harder. So from that standpoint, there's lots of conversation around it for sure. I would say anything less than 100 million in property is probably not enough to justify your own captive. If you're below that, you could rent a captive, but then again, you're in a for lack of a better example, a mutual fund almost, where you're buying space in the captive and you're going to share in the ups and downs of that whole thing. I don't think we're fully out of the woods on this. I think the market's going to continue to be rough. So I think we'll hear more and more about it. On the other item I would add to that, Pat, is something like parametrics. Now we don't hear as much about that on the family side. The businesses probably are more familiar with it. Think about it as like an AFLAC or an indemnity program where if you're in the hospital for 5 days, you get $100 a day, and you can get that. Where that cannot, I shouldn't say cannot, it should not replace a standard risk management plan. Which would typically include some type of insurance. It could be an adjunct or something to add to it. So we go into a California location. They're going to limit the wildfire, and they're going to say the first $1 million is on you, and you get the chance to do a parametric wildfire policy where you pay $10,000 a year. And if the sparks reach your property in any way, shape, or form, they'll pay you $50,000. I'm making that limit up, but you would pick it. And so the $50,000 could be for immediate expenses because there's no claim. If there's no claim adjustment, that if the fire blows sparks and it shows that it hit you at the side of your roof or the shed in the backyard, you're getting paid the $50,000. It's that simple. And so it's quick, it's clean, and it may fill in some of those gaps. And that is also in much more discussion, particularly with things like wildfire and some of the flooding. And it's a clean process, but the question is, if you can handle that deductible, then you may not do it. But that's available as well. So there are things in play that would fall under the self-insurance that go beyond just captives. Amber, I don't know if you want to add anything to that, but
no, you did okay. Very well. I'm glad you touched on the parametrics.
Yeah.
What about the administration of a captive? And aren't they regulated? So don't you have to be concerned about the cost and the talent to administer the captive and make sure that you're compliant?
Well, if you're standing one up, you're going to work with a company that would guide you through that. But that's another cost. That's exactly right. I mean, so I'll tell you the closest experience I had with it was a few years ago with a family with an active enterprise. And the principal had cattle, and I want to say it was 800 or 900 head of cattle, and he didn't have it insured at all, and they said it was uninsurable. And we met with him about a captive. He was all for it, and so he sent us off to the CFO, and we sat down and we said, "You're going to have to give us $500 million to stand this up." And the meeting ended 5 minutes later because he said he could put that capital to better use. And so that because all those expenses are now yours. And so the expense of the claim is yours, and the hiring the attorney or a TPA is yours. And so you're absolutely right. There's a lot of difficulties with that, but you're typically not going to do that on your own. You're going to go to, we have a captive specialist, so they would line all that up whether it's standing up your own captive or you're going to you're going to buy a cell in a captive. Many of them have moved onshore. I think you know that, Pat. I mean, Vermont has a bunch of them, and I'm sure Tennessee's gotten into it with the change in their tax laws. But there's all over the states now that you don't have to go to the Caribbean. You don't have to go to Bahamas. I mean, you can get Bermuda. You can get it done in the U.S., which is a little better because less travel. But the reality of it is there's lots of costs that go with it.
Well, that's very helpful. I see that we're almost at the top of the hour. So I want to thank both of you. This is excellent information. Well, every single participant stayed on. So that means that it was not only excellent information, but very interesting. So thank you so much for presenting today. We really appreciate it. And we hope everyone on this call enjoyed it as well. And I want everyone to have a great rest of your day. So take care.
Thanks again, Pat.
Thank you.
You're very welcome. Bye-bye, all.